This is the Chapter 8 in-class problems. We have 2 of them. So here's the first one. I think this is the first one. Yep. Here's the, I think it's the first one. Yeah, here's the first one. We completed the following transactions involving equipment. So on the first, we paid $287,600 cash plus sales tax plus transportation. It was FOB shipping. That means it became ours at the point of shipping. It was our responsibility to get it to our warehouse or whatever, wherever this is going, our place of business. So that means we need to pay that, and that's all part of the acquisition cost. 4-year life, 20,600 salvage value. Record them in the equipment account. And it says prepare the required journal entries. So I'm going to do that January 1st one first. Pull up the calculator. Here we go. And 287,600, 11,500, and 1,500 is $300,600. So we're going to record that as a debit to equipment and a credit to cash because we paid cash for this. Equipment is an asset account that we're increasing. We do that with a debit. Cash is an asset account that we're decreasing. We do that with a credit. Next, on January 3rd, we paid $4,800 to install air conditioning in the loader to enable operations under harsher conditions. This created the estimated salvage value of the loader by another $1,400. So first, let's record the cost of the air conditioning. This increased the salvage value. This is a betterment. So we're going to record that $4,800 as an increase in equipment. And the opposite, the other piece is cash. It doesn't say how we paid it, so we're just going to assume we paid cash. And again, equipment is an asset account that we're increasing, that's why it's a debit. Cash is an asset account that we're decreasing, that's why it's a credit. And then finally, record the annual straight line depreciation on the loader. So we need to figure out what a year's worth of depreciation is. And we're going to use that formula of cost minus salvage value over useful life. Oops. So cost is going to be the acquisition cost on the first, and also that improvement cost on the third. So it's at $300,600 plus the $4,800. So $305,400. And salvage value was given here, but on the third, that betterment that we made increased the salvage value. So 2,600 plus 1,400, 22,000. Over the useful life, 4 years. So let me work that math. 305,400 minus 22,000 divided by 4. 70,850. 70,850. And our journal entry for the depreciation expense is a debit to depreciation expense and a credit to accumulated depreciation. Depreciation expense is an expense account that we increase with a debit. Accumulated depreciation is a contra asset account that we increase with a credit. And then we've got this table down here that we don't really need because we've already we've already answered the question. This table is going to help us calculate the annual depreciation, but I will fill it in. The original cost plus the betterment equals the cost of the equipment minus the salvage value, and that was the 2,600 and the 1,400. Gives you the depreciable cost. And I don't know what that was. 283,400. That 283,400 divided by 4 gets us the 70,850. So you can do it that way, or you can do it the way I did here. Let's see if I can change this color. Yep, everything but the V. I don't remember what color I chose. Oh, there we go. Or you can use that formula that I just changed the color on. And I use that formula because that's what we saw in the slides when we talked about this in the class lecture. Next. Same example, now it's year 2. In year 2, we paid $5,400 to overhaul the loader's engine, which increased the loader's estimated useful life by 2 years. So this is an improvement. This is a betterment. We're going to record that to the equipment account. And again, it doesn't say how we paid, so I'm just going to assume we paid cash. The equipment account is an asset that we're increasing. That's why we debit it. Cash is an asset that we're decreasing. That's why we credit it. On the 17th, we paid $820 for minor repairs after an operator backed it into a tree. So this is not a betterment. This is just routine repairs and maintenance. Things like this happen. You got to fix it. We haven't done anything to increase the efficiency of the machine or increase the lifespan of the machine. So this is just expensed. Repair expense is probably what this is. Sometimes it's called repair and maintenance expense for the $820. And again, it didn't say, so I'm just going to assume we paid cash. Repair expense is an expense account that we're increasing. That's why it's a debit. Cash is an asset account that we're decreasing. That's why it's a credit. And then on the 31st, record the annual straight line depreciation of the loader. So we've got that similar formula that we saw in the slides, and it is book value minus new salvage value over new useful life. Very similar to the formula that we used here. Book value. Book value is the cost. Oop, is the cost minus any accumulated depreciation. So our cost is, from the previous slide, our cost is $305,400. But we added another $5,400 to it. So our accumulated, so our new cost, our new cost is $310,800 minus our accumulated depreciation. Our accumulated depreciation is any depreciation we've taken over the life of this. All we've got is in year one, the $70,850. So make sure I did this right. 305,400 plus 5,400 minus 78,850. 239,950 is our book value. Minus the new salvage value. Salvage value remains the same because on January 1st, when we overhauled it, it didn't say it changed anything about the salvage value. So the salvage value remains $22,000. Over the new useful life. So this one tends to trip people up. It's not too difficult, but I think it's easy to mess up. And sometimes when something's not really difficult, that makes it a little easier to make mistakes. So originally we had a 4-year life. We are sitting here at in year 2. So our 4-year life has 3 years remaining because year 1 is gone. And we've added these 2 years. So that's our new remaining useful life. Maybe I should put that in here. Our new remaining useful life is 5. So we've got 239,950 minus the salvage value divided by 5. 43,590. That is our depreciation expense and our accumulated depreciation. Depreciation expense is an expense account. We're increasing it. That's why it's a debit. Accumulated depreciation is a contra asset account. We are increasing it. That's why it's a credit. Again, I used that formula that we got out of the textbook, out of the slides, but we can fill this out as well. The total cost is what we came into the year with plus the betterment from the current year. The accumulated depreciation is just 1 year of depreciation. So it gives us a book value of 239,950 minus the salvage value equals our new depreciable cost. And what was that? 217,950. Our remaining useful life, so they give us room for the calculation there. We started with 4. We used up 1, which leaves 3. But then the betterment this year added 2. So our remaining useful life is 5. And that means our depreciation, 217,950 divided by 5 is the 43,590. So if you want to use that table, if that's helpful, I filled it out there. But from the slides, it's this piece over here. That's that problem. Then we've got this. We bought a machine, a used machine, for $178,000 cash on the 2nd. On the 3rd, we paid to wire electricity to the machine. On the 4th, we paid to secure the machine for operation. The machine is going to be used for 6 years, have a $14,000 salvage value, straight line depreciation. We got rid of the machine after the end of its 5th year. Prepare the journal entries. So on January 2nd, January 2nd is when we bought the machine. Does it say what account we should be using? It doesn't. So I'm just going to call this machine. $178. and cash is paid for all costs. So cash, 178. Machine is an asset account. We're increasing it. We do that with a debit. Cash is an asset account. We're decreasing it. We do that with a credit. And then on January 3rd, we paid $28.40 to wire electricity to the machine. This is part of acquisition cost. We can't use the machine if it doesn't have electricity connected to it. So we're going to put those costs into that machine account. And we paid cash. Machine is an asset account. We're increasing it. We do that with a debit. Cash is an asset account. We're decreasing it. We do that with a credit. And then on the 4th, 1160 to secure the machine for operation. Again, this is part of getting this thing ready to be used. This is all part of the acquisition cost. So same journal entry with just different numbers. This is a capital expenditure. 1160. And we paid cash. 1160. Once again, I hope you're getting a little tired of this. It means you're starting to understand it. But I'm going to keep doing it anyway. Machine is an asset account. We're increasing it. That's why this is a debit. Cash is an asset account. We're decreasing it. That's why that's a credit. So there's our journal entries. And now they want us to record the journal entry, prepare the journal entry to record depreciation at December 31st of its first year and its 5th year. So this is straight line depreciation. So let's take the cost of the machine, $182,000, and I'm gonna write the T accounts also. First, the cost of the machine is $182,000 minus salvage value over useful life. Salvage value is 14. So that's our calculation. Let me just finish this up. Minus 14,000 divided by 6 is 28,000 a year. That's our annual depreciation. So I'm going to make a T account. Let's see where I can fit this T account. Let me scoop this over a bit. Maybe that'll help. There we go. Let's make a T account over here. So for machine, every time we record to the machine account in a journal entry, we put the number over here in the T account. If it's a debit, it goes on the debit side. If it's credit, it goes on the credit side. So on the 2nd, we did 178. And on the 3rd, we did 2840. And on the 4th, we did 1160. And that total, so sometimes this is how we see totals. That total is 182. So there's the T account for the machine. And actually, that's for the whole 5 years. We're going to do depreciation for 5 years also. That's for the whole 5 years because we didn't do any betterments. It doesn't say anything about any betterments or anything else to the machine account. So it's been sitting at 182 for all this time. I'm also going to do a T account for the accumulated depreciation. First, let's write the journal entries. So first year is depreciation expense and accumulated depreciation for $28,000. Depreciation expense is an expense account. We're increasing it. We do that with a debit. Accumulated depreciation is a contra asset account. We're increasing it. We do that with a credit. And let's see if I can cheat here. The fifth year, the second year, the third year, the fourth year are all the exact same journal entry because this is straight line. $28,000 a year every year. There's been no betterment that changed our estimated salvage value or changed our useful life. So it stays the same for all 5 years. They just had to show the first year and the fifth year, but this is also the second year, the third year, and the fourth year. As a matter of fact, let me put that up here. For the accumulated depreciation, we recorded 28,000 in year 1 and year 2 and year 3 and year 4 and year 5. So if I wanted a total, I'm just going to multiply it by 5. 140,000 is our accumulated depreciation after 5 years. Now I wanted to write those T accounts because we got rid of the asset. And when we get rid of an asset, we always have to wipe out the asset account, the machine account, and also we have to wipe out the associated accumulated depreciation account. So I wanted to know what the totals were in those two T accounts. So let's look at our journal entry. Actually, we've got 2 of them. So let me create some separation here. I'm going to go 3A because it says we've got 2 separate situations, A and B. A is what if we sold it for $15,000 cash? B is what if we sold it for $50,000 cash? So first, let's deal with the 2 things that are always going to be there. We always have to get rid of the machine balance and to get rid of the accumulated depreciation balance. Accumulated depreciation has a credit balance, so I'm going to debit it. For $140,000. That's going to wipe out that balance in the T account. And the machine account has a debit balance, so I'm going to credit it to get rid of it. So when I record a credit over here of 182, that wipes out that account. So we always have to make those 2 entries. If there was cash involved, we have to make that entry. There is cash involved. Here in A, We sold it for $15,000 cash, so we brought in $15,000 cash. So I'm going to move my journal entry just a little bit here. And make room there for cash. Let's see here. There we go. And make room for cash. So we're going to debit cash for the $15,000 we received. Let me move this also a little bit so we can tell. There we go. So for the debits in this journal entry, we've got $165,000. And for the credits, we've got $182,000. So this is not in balance. What is the difference between 182 and what did I say? 165. Oh, 182 and 165. $17,000. Let me try that again. There's my problem. 140 plus 15. 155, not 165. So minus 182, $27,000. I need another debit for $27,000. Move this again. It's a nice thing about writing on electronic paper. It's easy to move stuff around. I need a debit for $27,000 to make my journal entry balance. When it's a debit, first, when we need this plug, it's a gain or a loss. When it's a debit, we call it loss on sale, or loss on disposal, or loss on machine, something like that. So there's our journal entry for 3A. And then let's do 3B. The cash is 50,000 instead of 15. But the accumulated depreciation is still a debit of 140, and the credit to machine is still 182. And I kind of went through that quickly. I just copied from 3A. We always have to get rid of the machine. That's the credit for 182. We always have to get rid of the associated accumulated depreciation. That's the debit for 140. And the problem said there's $50,000 cash that we received. So I recorded the cash. Now we see if we're in balance. 50 and 140 is 190. So we've got debits of 190 and credits of 182. So I need another credit of $8,000 and make sure, check my math. I need another credit of $8,000. And we're just going to use that plug, gain or loss. When it's a credit, we call it gain. And that's it.